What are we supposed to know about earnings per share? Very easy concept. Earnings per share, ladies and gentlemen, this is a performance appraisal metrics. Metric, I mean, to get earnings per share, which is normally acronymed like this, EPS, earnings per share. Basically, we shall take what we call the total earnings. Total earnings, all over number of ordinary shares. Total earnings, all over number of ordinary shares. Total earnings, all over number of ordinary shares. So please ensure you're writing these things as we progress. Anytime they want us to give them EPS, we shall always work with the total earnings all over number of ordinary shares. But which earnings are we looking at? These are basically earnings which are attributable to ordinary shareholders. So please qualify these by saying that these are total earnings attributable to ordinary shares. Attributable to ordinary shares. Attributable to ordinary shareholders. To ordinary shareholders. Please write like that. Attributable to ordinary shareholders divided by the nose. Divided by the nose. Nose, this one is number of ordinary shares, remember. Nose is number of ordinary shares. Number of ordinary shares. Number of ordinary shares. Very important, ladies and gentlemen. Exercise. Exercise number one. Exercise number one. They have given us, in this case here, profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders, they have given us 10 million. And then we are given here a number of ordinary shares, they are 2 million. And then somebody in this case here wants you to get EPS. Somebody wants you to get EPS. Somebody wants you to get EPS. So remember, this is profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders is 10 million. And then number of shares are ordinary shares. Number of ordinary shares are 2 million. Then they want you guys to do something very easy. They want you guys to get what we call earnings per share. Earnings per share. Earnings per share. They want you to give them earnings per share. So how do we get earnings per share? The formula is already here. It is profit attributable to ordinary shareholders, which apparently we happen to be having, which is 10 million divided by 2 million. Divided by 2 million. So you kindly, of course, you can see the answer here. The answer here is 10 over 2, which gives me how much here per share? Every share. Each share that we have is earning Kenya shillings what here? 5. Kenya shillings 5 is earning Kenya shillings 5. Ladies and gentlemen, listen and listen to me very well. Of course, this is a useless example. This is a very simple example. At this advanced level, you can never get anybody who gives you this kind of a question. So please mention there, example 2. Example 2. So example 2, ladies and gentlemen, this guy has done something very wonderful here. Example number 2. Example number 2. Example number 2, this is what we have. Example number 2. We have in this case here, profit after tax. Profit after tax, profit after tax, ladies and gentlemen, this has been given as 10 million. And then we have what we are calling preference dividends of 2 million. Preference dividends of 2 million. And then we have number of ordinary shares of 2.5 million like that. And then they want you to do something very simple. They want you to calculate EPS. I'm so sure now this one, very many students will not be able to get this correctly. Very many students will not be able to get this correctly. But you guys, I know you are above there. You're bright. You're bright. You guys are bright. You guys are bright. You guys are bright. So they've given us, this is preference dividends. Preference dividends. Profit after tax. Profit after tax. Right? And then we have here a number of ordinary. Whenever you see nodes, Whenever you see NOS, be it in advanced FM, be it in advanced FR, NOS stands for what here? Number of ordinary shares. Number of ordinary shares. Thank you very much. I can see what Eric Odinga has given me. Eric Odinga has known, ladies and gentlemen, that for us to be able to get profit which is attributable to ordinary shareholders, first of all, you must give a preference to preference shareholders. Pay them their dividends first. So they have gone ahead to give me now an improvised formula. Eric has told me that in this case, ladies and gentlemen, to get EPS, take profit after tax minus preference dividend. Minus preference dividend, and then you will come and divide this by the number of ordinary shares that you have. So you take profit after tax, you give first of all, in this case here, you appropriate preference dividends from there first, and then whatever is left is now the profit, which is attributable to ordinary shareholders. Right? Great. So then the profit after tax is 10 million minus preference dividends of 2 million, all of a number of ordinary shares of 2.5 million, which at the end of the day will end up giving me what figure? Which at the end of the day will end up giving me what figure as EPS, earnings per share. Earnings per share. Somebody already had gotten this earnings per share. Somebody already had gotten this earnings per share as 3 points. You guys are very bright. Can I go to the third exercise? Can I go to the third exercise? Can I go to the third exercise? Yes. Now, this third exercise is the most interesting, and I'm so sure you can even bet. If you guys like betting, you can bet. You can bet 1,000 bob. If you get this correct, I give you 1,000. If you don't get it correctly, you give me 1,000. Is there anybody who is ready for a bet? Is there anybody who is ready to bet with me here? Is there anybody who is ready to bet with me? Is there anybody who is ready to bet with me tonight? Anybody who is ready to bet with me tonight? You can't get this one. This one we can bet. Exercise number 3. So for this exercise number 3, they have given us profit after tax, right? 10 million. Then they have given us preference dividends. Preference dividends of redeemable shares. Redeemable shares, and then we have here preference dividends of irredeemable shares. So this is 1 million, this is 1.5 million, like that, and then we have the number of ordinary shares, which are 2.5 million, like that, and then they want us to give them the EPS. How I wish that I bet with you guys. How I wish I had a bet with you guys. Madam Queen, we have also just begun. And this is exactly what we are doing. This exercise, just join us from here. Join us from here. Like a buffalo soldier who fights on arrival. A buffalo soldier, you know, buffalo soldier, the American buffalo soldiers. If you're not careful, these guys will give you very bad shots. They'll shoot you, right? So you simply jump down from the vehicle here right away when you are shooting. Yes. So we have profit after tax, 10 million. We have preference dividends of redeemable shares, 1 million. We have preference dividends of irredeemable shares, 1.5 million. And then we have a number of ordinary shares of 2.5 million. So they simply wanted to get EPS. So which dividend am I going to subtract here? Which dividend am I going to subtract here? Am I going to subtract both of them, or preference dividend of irredeemable shares? Which one should I subtract? Now they are not talking. They're not talking. So, ladies and gentlemen, listen and listen to me very well. Remember, redeemable preference shares, these ones are normally treated as what here? as a loan. The money will be returned back. And whatever in this case here you pay out as dividends out of this nowadays is being accounted as finance cost, as interest. Ladies and gentlemen, it's only irredeemable shares that are normally classified as a form of equity. Remember, equity components are non-refundable, like ordinary shares. There is no way to come and tell me if I issued at the primary market, I gave you like 10 shares of RCM college, then later on, if you see things are not working, you can't sell those shares back to the college. You can never redeem your money. If you're so tired, go to the secondary market and sell those shares to another person there. So we only work with irredeemable instruments whenever it comes to calculations of what here? EPS, irredeemable, 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 irredeemable. So abracadabra, ladies and gentlemen, this is what we have. So we are calculating the profit attributable to ordinary shareholders. Attributable to ordinary shareholders, profit, or rather EPS, we are saying EPS here will be equal to profit after tax minus preference dividend of irredeemable shares. Preference dividend of irredeemable shares. Preference dividends of irredeemable shares. All over, Jackie, now I hope this makes it clearer. All over number of what here are ordinary shares. All over number of ordinary shares. So Jackie, you can see I've already factored in preference dividends of irredeemable shares. So I hope that makes this clearer. Right. So the profit after tax, ladies and gentlemen, is 10 million minus preference dividend of these irredeemable shares, which is 1.5 million. All over, ladies and gentlemen, all over, number of ordinary shares, which are how many here? 2.5 million. Great. Great. So is there somebody who got this really correctly? Is there somebody who got this right? Eric alone, right? Lenovo person, Ankara Align, AA. Great. Those are three. So I would have given out 3,000. But you see, in the process, I would have gotten 40 what? I would have gotten 46. I would be a rich man. I would be a rich man tonight. I wish we had a bet with you guys. I would be a very rich man tonight. Thank you so much. So now I want to give you the fourth example, which is a very important example. The fourth example, which is a very important example. So can I rub this? 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 Abracadabra, yes. Saumu Sumba, SS. Great. Great. Ladies and gentlemen, here we are. So this example is a nice one now. This example, yeah, they have given us, in this case here, profit after tax as 10 million. And then we have here 1st of January 2020, we issued 1 million shares. And then we have here 1st of April 2020, we issued out again some new shares, 800,000. And then, ladies and gentlemen, we have here 1st of September 2020, we issued 500,000 shares. 500,000 shares. So this is supposed to be exercise number 4. This is supposed to be exercise number 4. So these guys here want you to do something very simple. They want you to calculate the earnings per share. They want you to calculate the earnings per share. So could you kindly help me out here? Calculate the earnings per share for us. You can see now here, issued 1 million shares. Remember, all these are ordinary shares. All these are ordinary shares. that were issued in different dates. That were issued in different dates. That were issued in different dates. The financial year, it is 2020. Remember, we are working from beginning of 2020 up to the end of 2020. End of 2020. 31st of December 2020. So EPS 31st December 2020 like that. EPS 31st December 2020. Thanks for asking that question. That shows me that, Eric, you're a good financial reporter. Good financial reporters are very sensitive with dates. When are we supposed to be reporting? When are we supposed to be reporting? So abracadabra, abracadabra, abracadabra. What do we have there? Abracadabra. What do we have there? So I know what is at the back of my students' minds. My students' minds, of course, I have got great students. Great students, in this case here, we're not thinking like, how do we account for hyenas as biological assets, right? Great students who have great memories. So these great students must be telling me that, Mwalimu, in this particular situation, for us to get EPS, there must be a one-nose to be used somewhere. There must be a one-nose. There must be a one-nose. There must be a one-nose. Is there somebody here who has never heard of this word since they were born? Is there anybody who has never heard of this word before, since they were born? This is the very first time they're hearing this word, one-nose. Please don't fear telling us the truth, because we shall know. What do you mean? You've never heard of one-nose. We shall overcome, right? So then right there in full, that one-nose stands for weighted average number of ordinary shares. Weighted average number of ordinary shares. Patrick Talia, PT, has already given us the full meaning of one-nose. Of one-nose. Weighted average number of ordinary shares. So the first thing that we need to do is to calculate the weighted average number of ordinary shares. Is to calculate the weighted average number of ordinary shares. So first of all, before I endeavor onto this journey of calculating these one-nose, I would want to know whether there is any student who has been able to finish getting the EPS. Is there anybody who has been able to finish? So one-nose I'm being given here by Bwana Guga is giving me one-nose of 176.66, and then EPS is 5.66. The final answer, EPS is 5.66. Thank you, and thank you so much. You guys are very bright. You can see, you guys, I said this even before we began, that these guys are bright students. So, ladies and gentlemen, then, in this case here, what am I supposed to do here now right away? So, of course, when I'm calculating this one-nose, the money will not be used anywhere. One-nose, basically, I'm weighting my shares. I'm giving my shares weights, which are time proportions based. Time proportion based. Time proportion based. So in this case here, then what I need to do is something very simple. I will make a table. And in this table of mine, I will start by writing the date here. Then I have description here. I have description here. And then we have, ladies and gentlemen, another column here for cumulative shares, cumulative shares, cumulative shares, cumulative shares. And then we have another thing here for time proportion, like that, like that, like that. This is quite a simple example. This is a simple example. Now listen and listen to me. The first date that we have here is 1st of January 2020, when we issued how many shares? 1 million shares. We issued 1 million shares. So cumulatively, nothing much really to talk about here. It's 1 million there. Now from there, you go to the second one. The second one, we had this number of shares being issued on this date. So you take this and accumulate here, we are getting 1.8 million. All right. So the last one, please accumulate to this, which gives us 2.3 million. So first of all, are we together up to there? First of all, are we together up to there? First of all, have you been able to see what you have done for us to be able to get, in this case here, this cumulative, I've only accumulated these shares downwards. Right? Can somebody in this case here help me answer Emmanuel? Emmanuel is quite a big name, right? We are simply doing some example here, Emmanuel from Walimu's head, right? And then now from there, ladies and gentlemen, I would want us now to count the number of months, of which in this case here, there are 2 ways. And the way that I would recommend to you, and I'll tell you why, the way that I would recommend to you over counting this number of months, I would want us to be counting the number of months between the 2 transactional dates. 2 transactional dates. I mean, from 1st of January to 1st of April. How many months do we have here? Please start counting them. Please count them from 1st of January to 1st of when? April. How many months do we have? So you count. So we have January, we have February, we have March. Don't count April, because April, we were just beginning there. So here we have got how many months? Here we have got 3 months. How about from 1st of April to 1st of November, or rather September, 1st of September? Please count for me. How many months do we have there? Jackie is telling me 5 months. 5 months. You count from 1st of April. So the whole of April, May, June, July, September. September, no. Please count very well. Count very well. So we have April, right? So we have April, May, June, July, right? July, August. Don't count September. Don't count September. It's 5. You guys are right. Now, because we only had the 3 transactions in the year, the last transaction, you don't have to count the number of months, because normally we account for a whole year. The last transaction, always take it to be what year? Balancing figure. So balancing figure, to enable this give us 12. This will be what year? Somewhere. The balancing figure will be how many months? The balancing figure here, to make it 12. We want to account for a whole year. So it's 4, isn't it? It's 4. It's 4. It's 4. Oh, alternatively, you can also count from, in this case, ladies and gentlemen, September, October, November, December, up to the end, December. There are 4 months. You can count. There are 4 months. You can count there. You can count from right away September, October, November, December. There are 4 months like that. So of course here we have these are supposed to be time proportions. So 3/12, 5/12, 4/12. And because we don't have any bonus fractions, now come and create a column for one nose. So one nose, you simply take the cumulative shares times the time proportions, like 1 million times this. Please give me a figure to write here. 1 million times 3/12. This gives me how much? This gives me how much? 1 million times 3/12. 1 million times 3/12. 250,000, Rosie. 250,000. How about 1.8 million times 5/12? 1.8 million times 5/12 inakuja ngapi oye? Wanasema ni 750,000 eh? 750,000, 750,000. And then the last one, ladies and gentlemen, is this 4/12 times 2.3 million. 4/12 times 2.3 million, oh yeah. Oh yeah, nipatie madecimals kidogo. 2.3 million times 4 over 12. 2.3 million times 4 over 12. 766, 666.67. So please come and add for me to be able to give me what we call the total 10C. Total 10C. Total 10C. Total 10C. So the total 10C will end up giving us how much? Total 10C. Total 10C will end up giving us how much? 176, 600. So we have here 176, right? 176, 666, 666.67 like that. So 1 million. Naona kitu ingine mzuri. Kitu ingine mzuri. Hebu soma mzuri. Eka makoma mahali. Ukitaka kusema weka koma mahali. Unajua koma ziko wapi? You must use separators. You must use separators when you add. You must use separators. Why would you want to disturb mwalimu now? Why do you want to disturb mwalimu? 1, so there is a 6 I've left in between. There is a 6 I've left in between. Oh, yeah. Like that. So this is the 10C. And once I have the 10s, then getting EPS will not be a big issue. Getting EPS will not be a big issue. Getting EPS will not be a big issue because to get EPS, we'll take, in this case here, our profit after tax, they're not preference dividends here. Profit after tax, all over now, what we call the 10C like that. So who can remind us what was the profit after taxation? What was the profit after taxation? Abracadabra. What was the profit after taxation? Thank you very much. So it is 10 million divided by 1,766,666.67 like that. To divide like that. So if we do it that way, we shall be able to get earnings per share. Earnings per share, which will be 5.67 like that. 5.67 like that. And I know there are those students who will tell you that, you know what, we stayed with these shares for 12 months. The others, no, I don't use that approach at all. I don't like that approach at all, and I'll be able to prove to you that my approach is superior. My approach is superior. So first of all of us, are we now together here as pertains calculations of 1/0 especially? Are we together as pertains calculations of 1/0? Are we together? Yes. Thank you very much. Great. Great. Thank you very much. Now, ladies and gentlemen from there, I would want us to remind ourselves. Let's remind ourselves. What have we said here? We've got what we call, what we've calculated so far is called the basic earnings per share. Profit attributable to ordinary shareholders of the parent divided by weighted average number of shares, what we call 1/0. Or simply put, it is part minus preference dividends all over 1/0. But of course, at your level, you will not be required just to do this. You must go a step further and calculate diluted EPS for us. You must go a step further and calculate for us what we call diluted EPS. This is saying that the basic EPS might get worse due to things that are already in issue. That we have, ladies and gentlemen, outside here, we have been able to give what we call a convertible loan. So there are people like now what Kenya Airways did. They gave, or not Kenya Airways, but Equity Bank. In this case here, gave Kenya Airways a convertible loan. So Kenya Airways basically gave what we call a convertible bond. They gave equity. We got a loan, we gave a bond, that instrument, convertible bond. So what does it mean? One of the fine days, ladies and gentlemen, you will get Equity Bank coming and telling you, hey, we don't want our loan back. Stay with it. Would want, in this case here, our loan to be changed to ordinary shares. So if we change these to ordinary shares, it means automatically that now Kenya Airways number of ordinary shares are going to really become too many. And then, of course, when they become too many, profit being the same and the base has grown, the denominator has grown, then automatically the EPS will be diluted. EPS will go down. So dilutive, those instruments in this case here that have got impacts of what you're diluting, EPS, reducing the EPS, very important. The same case with stock options. Stock options, these are given to senior managers. You are telling these managers that, hey, when you are retiring, assuming that the performance of the company will be in the heavens up there, very high, we are giving you a right, but not an obligation to change this promise to shares. When they change the promise to shares, when they take up equity shares of the company, then the one-offs will increase. And when the one-offs increases, automatically that will reduce what here, the EPS, the earnings per share. Earnings per share. So, ladies and gentlemen, here we are learning something very important here. Yes, great. So, ladies and gentlemen, we are told here share options. This will mean more shares when exercised. The same case here with convertible loan. This will mean more shares when converted. Now, the most important thing that they're supposed to appreciate, ladies and gentlemen, in this particular class, the companies that report EPS. EPS is mandatory for all public listed companies, even not number 2 out. Public listed companies, ladies and gentlemen, must always report on EPS. No, EPS to be presented in the income statement. EPS to be presented in the income statement. This is basically profit after tax, less dividends. This is basically profit after tax, less preference dividends. Be careful of the type of preference shares though. Redeemable preference shares, redeemable means the money will be returned. These are actually liabilities. And their finance charge isn't a dividend in the account, but interest. Do not adjust for these dividends. You've seen in your past papers, ladies and gentlemen, where they're trying to trick you guys regarding this. Do not adjust for these dividends. And then we are given here irredeemable preference shares. These are now the equity instruments, and the finance charge is dividends. Do adjust for these dividends. Do adjust for these dividends. Ladies and gentlemen, I would want to play some movie for you. It's always important for us to have some movies being played. Of course, somebody will tell me, Mwalimu, we are very old. We don't want movies. Why? Movies are nice, They're very nice. They are very nice. So you can also take like this 1 minute to relax a little bit as I get something to play for you. I must play for you something today. We can't just remain like this without watching. You have to watch movies a little bit. Yes. Yes. Great. So please, first of all, get out this past paper of September 2015. September 2015. First of all, the pilot paper. Are you able to get that past paper? September 2015. September 2015, before I play this great movie for you. September 2015, do you have the past paper with you? Do you have the first paper? Do you have the past paper? Please get it out. Please get it out. Once you get it out, let me know that you already have it. Yeah, somebody should be able to share the question with Abdul Naji. Somebody to share the question. Jackie, please share the question. Share that past paper. It is September 2015, question number 4B. Question number 4B. Once you get that question, please talk to me. Once you get that question, September 2015, question number 4B. Once you get it, please talk to me. The movie is coming, Robinson, don't worry. I must always play good movies for you guys. I must always play good movies for you guys. But first of all, have you gotten the question paper? 𝐂𝐨𝐮𝐫𝐬𝐞𝐬 Limited, thank you very much, Mary. 𝐂𝐨𝐮𝐫𝐬𝐞𝐬 Limited, I would want to use this 𝐂𝐨𝐮𝐫𝐬𝐞𝐬 Limited to show you how we compute the WANOs. So Abel Kayowa has already gotten it. Tunangoja movie. Inakuja, don't do This is going to be a great thing. A great thing. A big thing, I can tell you. A big thing, I can tell you. So all of us, do we have access to this 𝐂𝐨𝐮𝐫𝐬𝐞𝐬 Limited? Do we have access to 𝐂𝐨𝐮𝐫𝐬𝐞𝐬 Limited? I can see Mary here. Is this Mary appear? Is this Mary appear? No, okay. So they have the question now. All of them have the question. All of them have the question. There is nobody who has not gotten this question. Thank you very much. Now the movie is here. It's a 10 minutes movie. Be very keen. Be very keen and attentive. Otherwise you'll not get anything at all. Yes. September 2015, question number
4B. Question number 4B. So they want us to give them basic EPS for each of the years ended 31st December 2013 and 2014. And then now we have the diluted EPS for the year ending 31st December 2014. A bright student knows that basic EPS is where we have low-hanging fruits. A bright student will tell you that for basic EPS, ensure that you get all the marks which are there, and then diluted, you can go for 50%, like 3, for example. So, ladies and gentlemen, we are told here 𝐂𝐨𝐮 Limited is a manufacturing company quoted on the Securities Exchange. The following information was extracted from the records of the company. On 1st January 2013, the company had issued an outstanding share capital of 300,000 ordinary shares of Sh20 each and 100,000 8% convertible preference shares of Sh50 each. All ordinary shares were fully paid and the preference shares were convertible into ordinary shares at the rate of 3 ordinary shares for every 2 preference shares fully paid. Note number 2, the company reported profits after tax of 1.2 million in the year 31st, ending 31st December 2013, and 1.8 in the year ended 31st December 2014. The profit for the year ended 31st December 2014 is after including a profit of Sh250,000 from operations discontinued in the period. Ladies and gentlemen, we like it that way because whenever we are getting basic EPS, we don't discriminate. Whenever we are getting basic EPS, ladies and gentlemen, would want the profit to be the profit we're going to use. The profit after tax we should use when getting basic EPS should be profit for both continued and discontinued operations. So listen, ladies and gentlemen, and listen to me very well. This is an ACCA question. I'll be able to give it to you. Weza kuona solution yake pia. Hii kitu ya kwamba profit of discontinued operations was included in terms of this basic EPS, it's irrelevant to us. We shall not deduct this. This is not the way we treat the profit attributable to NCI. Profit attributable to NCI must always be deducted, regardless. We are told on 1st April 2013, the company made a rights issue of 1 fully paid ordinary share at 60 for every 3 ordinary shares when the shares were trading at 84 each. On 1st October 2013, the company issued 200,000 ordinary shares at market price. Due to the high market price of its shares, 𝐂𝐨𝐻 Limited split its shares in the ratio of 2 fully paid ordinary shares of shillings 2 each for every 1 ordinary share of shillings 2 each on 1st April 2014, just like Equity Bank. About 5 years ago, Equity Bank realized that their shares were trading at a very high price. So you realize that your shares are trading at a very high price, and perhaps this ordinary wananchi, the individual investors are not able to afford them. What do? You split them. You can decide to split them into 2. You can split them into 4, depending on your objective. So like these guys, you can see here in the share split, ladies and gentlemen, you can see in the share split, you know, the shares here, the par value is 20. The original par value was 20. But now they have split this equally into 2. One share will be split equally into 2. And each is going to have a par value of what they are, of 10. It's a share split. It's a share split. But of course, if you get a bad examiner, at times they'll not even use this word 2 fully. What they'll do, they'll tell you that 𝐂𝐻 has split its shares into ordinary shares of shillings, for example, 5 each. So it's upon you to do a simple fraction where you take the old par value divided by the new par value. It's like 20 divided by 10. I'm so sure here 20 divided by 10. I'm so sure here that 1 old share is giving me 2 new shares. If, for example, the new par value was 5, then I would have said 20 divided by 5. I would have known 1 old share was to give me how many new? 4. I'll come back to that. Note 6. The company offered 200,000 stocks or stock options on 1st June 2014 with an exercise price of 30 when the average market price per share was 40 in the year. None of the options were exercised. No worries. 7. On 1st July 2014, the company issued 8% convertible debentures amounting to 4 million. The debentures convertible into ordinary shares at the rate of 60 paid ordinary shares for every 1,000 of the debentures. None of the debentures were converted in the year ended 31st December 2014. The company had issued 6% debentures with a nominal value of 5 in the year 2010. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debentures. None of the debentures had been converted by 31st December 2013. However, on October 1st, 2014, holders of 3 million debentures converted them into ordinary shares. Corporation tax rate is 30%. So they want me to give them the basic EPS for each of the years. And if I'm the one doing this, I know the low-hanging fruits. So I'll start with 𝐻𝐻. And unfortunately, because now we never completed this question yesterday, I have to begin from the beginning. Lakini takimbia mbio sana. Mimi ni mtu wa mbio kabisa. So I'm beginning from scratch. So I'm calculating 𝐻𝐻. How many years do we have in this question? How many years do we have in this question? How many years do we have in this question? Which years are this? Which years are this? Which years are this? Which years are this? They're not talking to me. They're not talking to me. 2013 and 2014, isn't it? So kama ni 𝐻𝐻, lazima uweke na miaka hiyo, ufanye hizo miaka mbili. So tunaanza na 𝐻𝐻. 𝐻𝐻 is weighted average number of ordinary shares. So tunaanza na the year 2013. Tunaanza na the year 2013. So hapo unaandika kale kitabu kile tunasema date, unasema straight away particulars ama description ama working. Nimeona mnazoea kutumia jina particulars. Tumekuwa accountant kabisa hata mimi, particulars like that. Right? Alafu hapa anakuja anasema total number of shares, total news, total number of shares. Hapa anakuja anaweka time, hapa anaweka bonus fraction, alafu naweka column ya nini? Ya wanos, ya wanosi, ya wanosi like that, ya wanos like that, ya wanos like that. Yeah. So ladies and gentlemen, always lazima uanze na beginning of the year. Lazima uanze na beginning of the year. This is 1st of January 2013. 1st of January 2013. So are we together? Can we get, I want to start now. 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 Thank you very much. So I would want to know the number of shares that we began with. Number of shares that we began with. Wanatuambia on 1st of January 2013, the company had issued an outstanding share capital of 300,000 ordinary shares of 20 each and 100,000 8% convertible. If it are convertible due preference, convertible, ladies and gentlemen, debentures, share options, those things will never find their way to my what year? To my weighted average number of ordinary shares. Not unless they were being converted, not unless they were actually converted to ordinary shares in the year. Kama unaambua they were never converted, hatuna maana. So kitu ya maana hapo ni kwamba tuko na balance brought down. We have some balance brought down on this date over how much here somebody over how many shares. What is the balance brought down? How many shares do we have there? Somebody 300. So kumbukeni ni column ya cumulative oye. Hii ni column ya cumulative. Wameniambia itakuwa ni 300. So usikaende kujaza hii column hii at all. Hizi column usijaza at all. Hizi na kujanga baadaye. Enda kwa the next date. Enda kwa kwanza unajazanga hizi macolumn peke yake hizi mwanzo hizi 3 mwanzo. Enda kwa next date. Next date ladies and gentlemen ambao tuko na maneno pale. Next date ambao tuko na maneno majimaneno ni date number 2. Not even date number 2 is nothing to us because date number 2 is talking about profitability. So we go to date number 3. Date number 3, on 1st April 2013, the company made a rights issue of 1 fully paid ordinary share at 60 for every 3 ordinary shares. I love this because, ladies and gentlemen, I can see the date here is 1st April 2013. It's well within our year 2013. It's well within our year 2013. So nitakuja niseme hapa 1st April 2013 we had a rights issue. A rights issue over how many shares to how many shares? How many shares to how many shares? What is the ratio given there? What is the ratio given there? What is the ratio given there? Abracadabra. What is the ratio given there? 1:3. 1:3. Usiponiongelesha leo na vile nimeona mko smart moye. Huwezi kuwa smart hivyo ndio ukose kuongea. Aya. Umesema on 1st April 2013 the company made a rights issue of 1 fully paid ordinary share at 60 for every 3 ordinary shares when the shares were trading at 84. Wachana mambo ya mbesha kwanza. Hapo naambiwa ni 1 new for every 3 all that you have. Kwa hivyo itakuwa 1/3 times what here somebody the shares we have which are outstanding. So 1/3 times 300 gives me how many shares? I have cut my 3 zeros. Yeah, that gives me 100. So kumaanisha cumulatively up to date tuko na shares ngapi oye? To date tuko na shares ngapi oye? 400. Because we are accumulating, it's cumulative like that. Usikajaze hizo columns hizo terp na achana nazo kwanza. Wewe endelea tu kushika shares zote mpaka mwisho wa mwaka. Endelea kushika shares zote mpaka mwisho wa mwaka. Ladies and gentlemen, we are told look at note number 4. Note number 4 wanasema on 1st October 2013 the company issued 200,000 ordinary shares at market price. So we have which date? 1st October 2013. That is a date which is well within our year. So we have here 1st October 2013. We had the issue of shares at market price. There was no bonus, market price. And how many shares were given out in total? How many shares were issued out in total? 600. Are you sure, Janet? It's 200. 200. It is 200. So it is after we bring the 200 in the total cumulative column that you'll end up getting what somebody there? 600, like that. 600, like that. Now you go to the next date, ladies and gentlemen. The next date, 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 the next date. We are told here the company offered, due to the high market price of its shares, Ozen Limited split its shares in the ratio of 2 fully paid ordinary shares for each. Look at the date. On 1st April 2014, this thing has crossed over. It's not well within this other side of River Jordan. It has gone to the other side. Yeah, so that will come in a different year. So are we together that these are the only transactions that took place in 2013? Are we together that these are the only transactions that took place in 2013? Yes. So then let us compute the 1OC. So the 1OC, first of all, I would want the time fraction. I would want the time fraction. And this is how we count. This is how we count. This to this. This to this. So 1st of January to 1st of April. How do you count, ladies and gentlemen? How do you count? How many months do we have between 1st of January and 1st of April? 1st of January and 1st of April, you are counting January, February, March. When I try to touch April, I remember April was just at the beginning. So you're only counting January, February, and March. So 3 months. So then this time fraction will be 3 out of 12. How about, ladies and gentlemen, between this date and this date? Between this date and this date? Between this date and this date? Rosie anasema 7. Mimi, I can never trust any lady with dates. Right? Right? So, ladies and gentlemen, we have to count together. So we are counting together April, May, June, July, August, September. So before I say October, you see October was at the beginning. Should be 6 months. So it is 6 out of what year? Out of 12. 6 out of 12. And because there were only 3 transactions, even without counting, I know counting at times is not very easy, but because there were only 3, I can use the balancing figure concept. How many months to the end now? How many months to the end? It will be 3 out of 12. 3 out of 12. Ladies and gentlemen, in this question, we had a bonus. A bonus in the context of what here? A rights issue. So with the rights issue, I would want its fraction here. It's bonus or rights fraction. So come here and give us the rights fraction. Yeah. So for the rights fraction, first of all, I would want the theoretical X rights price. I would want the theoretical X rights price. When do we niambia tu saa hizi tu at ni 1 new for every 3 old? And have they given us their prices? Do we know this 1 new share in the right? How much? Jabir tells me that the 1 new is 60. The 1 new is 60. The 1 new is 60. And the old one, Shem is telling me, is 84. These figures are given here. 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 We are told here on 1st April of 2013, the company made a rights issue of 1 fully paid ordinary share at 60 for every 3 ordinary shares at 84, like that. Thank you so much. So ladies and gentlemen, then could you kindly give me this figure? So 1 times 60 gives me 60. 3 times 84 gives me how much? 3 times 84 gives me how much? Wongo. 252, thank you very much. 252, thank you very much. So total gives me how much? Total gives me how much? 312. And this 312 now is for how many shares? is for how many shares? If you add this, it's for how many shares? 4 shares. And therefore the TERP will be the 312 divided by 4. 312 divided by 4. 312 divided by 4, which gives me 78. Thank you very much. So then could you kindly, after getting the TERP, could you kindly give me the bonus fraction there? Give me the bonus stroke rights. Give me the bonus stroke rights fraction, stroke rights fraction, stroke rights fraction. Give me the bonus stroke rights fraction. Ah, you guys are very good. Mnajua ni market value of a share over the TERP. Market value of a share, the bonus fraction, I can even write here, the bonus or the rights fraction, or the rights fraction, or the rights fraction. It's normally the market value of the old share, the normal value without discounting, all over the theoretical X rights price. So mnasema the old market value was 84 divided by the TERP, which is 78, which is 78. So this is so important to me, 84 over 78. Remember this one, I'm supposed to be coming and placing it here. But remember the concept, ladies and gentlemen, that this is basically an adjustment fraction. It's an adjustment fraction which affects all the predecessors, the ones which are on top of the rights. So I can never put it here. So this 84 over 78, I can only put them on the top transactions. If there were 20 of them on the top transactions, each one of them. So here it's only one which is on top of us. So I'll come and put 84 over 78 like that. And that is it. So then you should be able to give us the one-offs. So you should be able to give us the one-offs. So how do we get the one-offs? You take the cumulative shares times the time fraction times the bonus fraction. You give me an answer here, whole number. They're giving me 80. Remember this 300, right? 300, not 300,000, not 300,000, not 300,000, 80 point, okay. If you want 2 decimal places, no worries, 80.77. Thank you very much. How about this other second transaction? 400 times 6 over 12. 400 times 6 over 12 gives me how much? 200. This gives me 200. How about the next one? The next one is 200. No. 600 times 3 over 12. 150. Thank you so much. Thank you so much. So this is 150. So please come here and give me the total one-offs for 2013. Give me the total one-offs. Give me the total one-offs for 2013. Give me the total one-offs for 2013. 430.77. 430.77. 430.77. These are one-offs for 2013. So with your permission, I will wrap this. I go to the next year. Remember, I'm supposed to do 2 different tables for 2013 and for 2014. Usikashikanishe hizo tables zote hazi kushikanishwa. Usikashikanishe. So can I go to the next year? Can I go to the next year? Yes, thank you very much. So then we shall come now to 2014. So hiyo table mpya nitaandika namna hii. Nitakuja hapa niseme one-offs 2014. Nitakuja hapa niseme one-offs 2014. So one-offs 2014. So one-offs 2014, I'll leave everything as is, except of course the transactions now here will be new. The transactions now here will be new. The transactions now here will be new. So please let me know once you are able to put up your skeleton for 2014. Please let me know once you have been able to draw yours like mine. Rosie anasema yes. Jabir anasema yes. Joy anasema yes. Great. Na wote kama Joy hata hakuweka hata video yake tumuone. Penina hakuweka video yake tumuone. Wamesema kesho, right? Wamesema kesho. Mwalimu should be able to place, right, the face to these good names. Yes. Kama Guga alikataa kabisa. Guga alikataa kabisa, but we shall overcome. We shall overcome, right? We shall overcome. Yeah, thank you very much. So which date should I start by writing here in 2014? Which date should I start with? Which date should I start with? Thank you very much. It has to be beginning. So 1st of January. So we have here 1st of January 2014. 2014. So particulars here, the first particular itakuwa ni gani? First particular balance brought down. Thank you very much. So then give me the number of shares that you're bringing down here. The number of shares. You'll get some students who, for whatever reason that I've never understood, some students will bring down the one was here. We are bringing down the cumulative number of shares from the other table, 600. Don't go to the time fraction. Don't do nothing there, right? So from there, go straight out to the next transaction that took place. Go there to the next transaction that took place. The next transaction there, now in 2014, isn't it? In 2014, the very first, actually after bringing it down, the very first transaction is this one here. Due to the high market price of its shares, Ozen Limited split its shares in the ratio of 2 paid ordinary shares of shillings 10 each for every 1 ordinary share. Which date is this? 1st April 2014. So we have here 1st April 2014. So what happened here? It's a share split. No more share split. Share split. It's a no more share split. And how does this share split look like? It's 2 new equals what here? Somebody 1 old. 2 new. So if you had 1 share, old share, we're giving you how many? 2 new shares. So now, ladies and gentlemen, what do you know about share split? Can somebody give me 1 sentence about share split? I know you guys are experts of EPS. I'm so sure here somebody must have been taught this EPS by so many teachers, like 2 or 3 teachers. So I'm so sure here I'm not teaching people who don't know. I'm so sure here that I'm teaching people who are doing master's because of having been taught this thing here severally by many teachers. So, ladies and gentlemen, let me ask you a question first of all. If I was giving 2 new for every 1 old, so now that we had 600 shares, after splitting, these guys ended up having how many shares? Kumbe mnajua. After splitting, we are basically doubling their shares. We are doubling their shares. What if they told us that it was a reverse split? What if they use the language reverse split? What if they use the language reverse? Thank you very much. It would have been 3. I would have divided by 2, isn't it? Thank you so much. Now listen and listen to me very well. When they talk of this forward split, what I'm supposed to do, it's very easy. I'm supposed to go to all the transactions that I have up here. I multiply them with 2. All the transactions that I have up there. Yeah, consolidating, yes. Consolidating, yes. But now this one is not about consolidation of shares. This one is about increasing the number of shares. We're increasing the number of shares. So it should be 600 times 2. So 600 times 2 gives me what figure? Somebody here? It gives me 1,200. Is that okay? It gives me 1,200. 1,200. Alafu ukaambiwa na mwalimu wako vizuri, ukishafanya this adjustment for all the transactions up there, unakujanga na kalamu yako ya blue, unafanya share split, unavuta ni kama haijawahi onekana anywhere. Yani unavuta kabisa na hasira. Wasichana hapa hasira, mimi sioni wasichana, lakini nawaambia ukweli, tukivuta hii atuvutange na rula, atuvuti na rula, tutataka kuweka yani share split, you only adjust for the transactions that are up there and then you hide it like this. Usiniambie umechafua kitabu yako. Right? So yani hautakuja baadaye uanze kusema ati unahesabu ati miezi kutoka hapa mpaka hapa. Umeficha kila kitu mpaka date. Namna hiyo. Lakini unajua hapa usikafiche 1200 wewe. Hii 1200 kwa line nyingine. Hii 1200 kwa line nyingine. Hizo tunaficha ni hizo zote hizo kwenda huko zote. Like that. Ladies and gentlemen, thank you very much. Could we kindly go to the next date? Could we kindly go to the next date? So now, are you able to see our brother Stephen Guga? Are you able to see our brother Stephen Guga? Honorable, yeah. You guys have been thinking he's a young man. Do we have Lucy Allen here? Lucy Allen, unfortunately, is excellent, yes. Thank you so much. Okay. Great, 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 great. He deserves respect, yes. He deserves respect. You know, at times in this case, he speaks and people think that perhaps he's on the payroll of RCM. No. When I understood Mayom understand, not Mayom, but this guy called Guga, he understands business. He understands business. Yes, yo mtu wa kuria, anajua mwalimu akifunza namna hii anafaa kunywa maji. Like that, he understands business. Hakuna mtu anazalipa Mayom. Mayom is a senior man in Kisumu County. Huwezi mlipata, mimi siwezi mlipa. You thought ni mtu wako campus, you know? Inshallah bakam. Great. He's an MBA already. Thank you so much. Sasa kujeni hapa. So tuende kwa the next date. Thank you so much. Tuende kwa next date. Tuende kwa next date. Next date. Next date. So the next date, what are we told here? Ya 2014. Hebu nitafuteni next date ya 2014 tuone. Next date unasema on 1st July. No, hapa, note 6. The company offered 200,000 stock options on 1st June 2014 with an exercise price of 30 when the average market price per share was 40 in the year. And none of the options were changed to these ordinary shares. So these ones are the potential dilutive instruments. We will use these for part 2. When we'll be calculating the diluted EPS. But for part 1, really, these ones will not be used at all. Go to note number 7. On 1st July 2014, the company issued 8% convertible debentures amounting to 4 million. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debentures. None of the debentures were converted in the year ending 31st December 2014. So really, this will not affect our basic EPS computation. So for now, note number 7 is noise. Note number 8, the company had issued 6% debentures with a nominal value of 5 million in the year 2010. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debentures. None of the debentures had been converted by 31st December 2013. However, for 2014, something happened. And now we are doing 2014 year. However, on 1st October 2014, holders of 3,000, because I'm cutting 3 zeros, debentures converted them to ordinary shares. Great. So we must pick this date, 1st October 2014. 1st October 2014. So we have here 1st October. We have here 1st October. We have 1st October 2014. There was conversion. Conversion of how many debentures? 3,000 debentures. At what rate? At what rate? At what rate? What is the rate? What is the rate? What is the rate before I answer those students? What is the rate? What is the rate of conversion? What is the rate of conversion? So this is 60 for every, how many debentures? For every 1,000. So this one here, please give me this figure first of all. 3,000 times 60 over 1,000 gives me how much? What, ladies and gentlemen? 3,000 times 60 divided by, so somebody tells me this should be 180. But remember here, I will come and put a big B. I'll come and put a big B. Could you kindly just guess, what do you think in this case does that big B stand for? What do you think does that big B stand for? That big B, what do you think does it stand for, somebody? This big B, what do you think? I'll have to put a big B. Not A, not A. Not a, can you guess? Can you guess? Can you guess? What do you think does this big B stand for? If you're not guessing, then I'll not tell you the answer. If you're not guessing, I'll not tell you the answer. If you're not guessing, I will not tell you the answer. I will not tell you the answer if you guys are not guessing. I will not tell you the answer if you're not guessing. If you're not guessing, I'll not tell you the answer. Ladies and gentlemen, listen, beta, a bonus? No. Thank you very much for those good guesses. Thank you very much for those good guesses. Ladies and gentlemen, remember we must keep on using a B and A. Sana sana, wakati kuna nini? Share split. So, ladies and gentlemen, I've used B because this particular instrument you are converting here was issued way longer before this split happened. Remember, this split happened in the year 2014, but these debentures were issued, these debentures you are converting there. The debentures that you are converting there, ladies and gentlemen, were issued. The debentures we are converting there, ladies and gentlemen, look at these debentures. When were they issued? The company had issued 6% debentures with a nominal value of 5 million in the year 20, long time ago. The debentures were convertible into ordinary shares at the rate of 60 fully paid ordinary shares for every 1,000 of the debentures. None of the debentures have been converted by 31st December. However, on October 2014, holders of these 3 million debentures converted them to ordinary shares. How many ordinary shares? 108. Ladies and gentlemen, listen and listen to me very well. We are saying here that these debentures that we are converting today, they were issued long time ago in 2010. And then we had a share split here, a share split which happened on 1st of April 2014. All right, all right. And then now we have these convertible debentures are being converted here. But you see, we are saying that these financial instruments that are being converted here today are very old. They came much earlier. They came much earlier here before the split. And any transaction, ladies and gentlemen, that came before the split must always be affected by the splitting ratio. Must be affected by the split. So if it's whenever you see this B, remember the split you are multiplying by 2. So you must come and multiply this thing here by 2 as well. You multiply it by 2 as well. Why? Because the debentures that you are converting here were issued earlier on. So they must be struck with this split ratio. So could you kindly then give me this figure, somebody? Give me, this gives me 300 what here? 360. This gives me 360. Nataka mulisikize. Nataka mulisikize. B is before. Nataka mulisikize. Je, kama ingekuwa ni rights kama hizi, for example, I mean shares kama hizi. Ebu angalieni, for example, kama note number 7. Nataka tuelewane. Kama note number 7, look at note number 7. On 1st July 2014, the company issued 8% convertible debentures amounting to 4 million. Assuming that these are the debentures that were being converted, ladies and gentlemen, this time around, would have we multiplied them with that 2 of the split, of the share split? If these shares, these debentures are mean in note number 7, if they are the ones that we were converting today, would have we multiplied them with the 2? Would have we considered them in the split arrangement? No, because 1st July is after the split. You see, the split happened in 1st of April 2014. The split happened in 1st of April 2014. So that is A, after. That is after. Ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. The arrangement that we have here is for shares. Shares in this case here that were done what? Shares in this case that were done what? This note number 8 were for shares that are very old, that were issued much earlier before the split happened. That's why I'm multiplying them with the 2, the split. They are also candidates of being split. They're also candidates of being split. Ladies and gentlemen, listen and listen to me very well. So we have here 360. When I accumulate here, 1200 plus 360 gives me what figure? 1200 plus 360 gives me what figure? 1200 plus 360 gives me what figure? It gives me 1560 like that. So do we have any other transaction in this year? Do we have any other transaction in this year? Do we have any other transaction in this year? No. The only thing I'm seeing here is this corporation tax, which does not affect us in calculations of what year? The one-offs. So now I can read the answer. I can read the questions. The date cannot be written. Even the date you rub it. Even the date you rub it. Yes. So could you then kindly come and count now number of months? Let's count number of months. Let's count number of months, the time. Let's count the time. So like now here, I'll be counting the time from this balance brought down to this date of conversion. Who is able to count? Who is able to count? Masi Wambua. Anasema 9. 9 over 12. Mayoma has been able to confirm. So remember now we have only 2 transactions. Hii transaction ya mwisho hakuna haja ya kufikiria sana. Hii transaction ya mwisho hakuna haja ya kufikiria sana because unajua lazima zi balance 12 over 12. So hii inakuwa 3 over what year? 3 over 12. Lakini kwa kuna time ya kutupa unaweza kaeka, unajua hata pia kwa exam unaweza kustua. Unajua tunaishi maisha na kustuana. Unaweza kaenda kwa exam kama una kitu ya kuandika, unaweza kuhesabia watu kwa exam. Watu wako wengi, unaweza kuhesabia vizuri. Unasema Oktoba, leo unaongea na nguvu. October, November, December. Andika 3 over because that is the only thing you know in the exam. Right? Ladies and gentlemen, do we have any rights issue here? Do we have any bonus in 2014? Do we have any bonus? No. So nothing there, nothing there. So then could you kindly give me the one-offs here very fast? Could you kindly give me the one-offs here very fast? So one-offs, where did we cancel the share split? You know, share split normally, you make the adjustment. If, for example, the shares were being split into 4, you simply come and multiply these up transactions with 4, and then you remove. Share split must be removed because it doesn't serve any. It doesn't serve any significance. What if it was a share consolidation? I would have divided this by 2 and removed as well. And of course, this before, after is applicable throughout. Okay. So then what do we have here, somebody? This is 1200 times 9 over 2. You guys are not giving me answers. Why? 900. Thank you very much. How about this one here? 1560 times 3 over 12. 1560 times 3 over 12. This will give me 390. So when you add here, then now you have the one-offs for 2014. You have the one-offs for 2014. One-offs for 2014, which is what year? 1290. Which is 1290. Just like I keep on asking, is there anybody who used a different formula, but at the end of the day, they have gotten the same answers with me? Is there anybody who has used a different methodology, but at the end of the day, they have gotten one-offs? Why 9 over 12? Because of the time difference between here and here. Yeah, between this one and this one. I know, ladies and gentlemen, there are those of you who will be doing like these shares. We stayed with them for 12 months, like 12 over 12. And then this one, right? But at the end of the day, ndio tulikosa. Lakini nyinyi ndio mko wrong. Mimi nafanya kama mmekuja kwa ile kampuni ambayo nafanya kazi, hizi vitu mimi nafanya practical. Anafanyia kampuni kubwa sana. Nafanyia kampuni kubwa. Mimi siwezi kosea swali ya EPS. Because these are the things I do every day. These ones with group consolidation, employee benefits, basically the entire IFRS. You mean a practice every day. Aya. Huyu anasema nirudie hapa kwa before. Nyinyi mlikuwa mnafanya namna gani kwa class? Because I'm so sure you must have done this thing in class. Mlikuwa mnafanya aje? Ukija after share split, the transactions coming down below here. Were you not looking at the dates of this transaction? Was this contract entered before? If the contract was entered before the share split, then even this one becomes a candidate of what you are splitting. I don't know whether you are able to remember this. You must have done it in class. You must have done it. You must have done this. 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 I work with a company called like this. It's a competitor of SAP. Yeah, a competitor of SAP, yes. Wilfred does not remember. Is there somebody who is able to remember doing this with their teacher, regardless of which college you are studying? Is there somebody who is able to remember that you did this with your teacher? Okay, perhaps the method you used could have been different. The method you used could have been different. The method you used could have been different. What of the final answer? Was the final answer the same? Was the final answer the same, 1290? Is the final answer the same? This final answer? No, we cannot move, because even if we move, I mean, if we are not agreeing, because we'll get this thing in the diluted formula quite a lot, the one of before, after. So it's good we agree. It's good we agree. We did the same with Norbert, though different methods. Answer was the same. Answer was the same. 5 minutes break. I'm meeting this for the very first time. But now what we need to ask ourselves, as and gentlemen, have we understood this? Because I know I'm teaching you the proper thing. Have we understood this concept? That should be the thing now. That should be the thing now. So ladies and gentlemen, now from there, now what I need to do, thank you very much. Now what you need to do is to come and calculate for us the profits attributable to ordinary shareholders. You give us what we call the PAUs. Give us what we call the PAUs. Give us what we call the PAUs. The PAUs, the profit attributable to ordinary shareholders. How do we get this? We normally take the profit after tax. We less profit attributable to NCI. We less profit for the NCI. And then, of course, we less what here? Preference dividends. Preference dividends. So you've got 2 years there. We have 2013, 2013, 2013, and then we have 2014 like that. 2013 and 2014 like that. So are you able to see the profits that have been given here? Are you able to see the profits that have been given here? The profits that have been given here. So profit, ladies and gentlemen, for note number 2. Profit, ladies and gentlemen, profit in this case here for note number 2. Year ended 2013 is 1200. So here we have 1200, and then 2014 we have 1800. 2014 we have 1800 like that. Do we have any profit which is attributable to NCI? No. The profit that we have here is the one which is attributable to discontinued operations. We don't subtract that. When we are getting, ladies and gentlemen, when we are getting basic EPS, we don't subtract profit attributable to discontinued operations. So this one here is 0 here, 0, no NCI profit, but preference dividends, we have them. Preference dividends, we have them. Preference dividends, we have them. The preference dividends, we have them. Preference dividends, we have them. Note number 1, on 1st January 2013, the company had an issued and outstanding share capital of 300,000 ordinary shares of shillings 20 each, and 100,000 8% convertible preference shares of 50 each. Thank you very much. So could we kindly convert that or rather calculate this preference dividend? So nasema ilikuwa ni 100,000 and each 100,000, this 100,000 and each was worth 50. and the preference dividends percentage is 8%. So Esther Chebet ananiambia ni 400, and then remember, ladies and gentlemen, that in 2014 we never redeemed. There were no changes in this preference shareholding, preference shares category. There was no changes. So it's 400, 400. There is nowhere they told us that they redeemed these preference shares, nowhere. Or they increased, nowhere. So please come and give me this profit per house. Give me this per house. So ya kwanza itakuwa ni 800. Ya pili je itakuwa 800 minus 400, which gives me what figure, somebody here, which gives me 1400. Unfortunately, we have our one-offs. Fortunately, we have our one-offs. So one-offs for 2013, what do we have there? One-offs for 2013. One-offs for 2013, what do we have here? One-offs for 2013. One-offs for 2013, what do we have here for one-offs of 2013? So mnasema ilikuwa ni 430.77, isn't it? Alafu ya 2014 ilikuwa ngapi, somebody? Ya mwisho ilikuwa ngapi hapa 2014? 1290. 1290. So please go ahead and divide for you to be able to give us the BEPS, the basic EPS. The basic EPS. So the first one here is 1.86. How about the second one? So you're taking this divided by this, which gives us 1.08. 1.08. Is there any need for us to do any restatements here? Do we need to restate the EPS, the comparative restated the EPS? No. So this automatically marks the end of what year? Our basic earnings per.
Charts zimekuwa mingi sana. Walikuwa nafuata kweli? Hawa wamekuwa na charts mingi sana hawa. Hawa wamekuwa na charts mingi sana. Wamekuwa na charts mingi sana. Ni nini tukianza namna hii? Nani ameshika zero? Nani ameshika zero 100%? Hajapata chochote. Zero. Marina amesema mimi 0 100%. Is it one knows that you are not able to know how to calculate? Amko mnajua ni video. Niliwaambia. Niliwaambia ni video. Ama nyinyi mlichelewa. Oh. Sikuwa naangalia huko juu kwa nini. Very good. Pole. Hiyo ndio sasa nilipotea hapo. Sikuangalia hiyo chat section. Pole sana. But at least the most important thing that I want to believe is that you guys have been able to know how to calculate one-offs. You guys have been able to know where to calculate, or rather how to calculate one-offs. Tuanzie kwanza hapo. How to get weighted average number of shares. Hiyo mmejua ama mjejua? Sorry for that. Hiyo mmejua ama mkujua? Niambie ni kwanza one-offs. Tuanzie hapo. One-offs. Wachana na hiyo kwanza, hiyo international disaster, wachana na hiyo term. One-offs. Umejua kweli mambo ya one-offs ama hujajua? Weighted. How to come up with the one-offs for the 2 years. Yeah, one-offs for the 2 years. Wachana conversion. Please, kwa mwanafunzi mzuri unasikia kwanza swali kwanza. One-offs, how to calculate one-offs. Hiyo umejua hiyo? Iko sawa. You know, the most important thing, that was my today's objective. So I'll send you this video. Una make sure umeangalia video tena. Hiyo mambo ingine ya theoretical X rights price, for instance, in this case here, you'll be told, very easy, theoretical X rights price, you'll be told here, for example, theoretical X rights price. Theoretical X rights price. You'll be told that we have a rights issue. We have a rights issue. A rights issue of 1 new, for example, for every what year? For every 5 shares held. Every 5 shares held. 1 new for every 5 shares held. Remember, a rights price is normally cheaper, right? So in this case, you'll be told in this case that, for instance, the normal market price per share is, for example, 50. And then we'll be told here that the rights price in this case here, for example, is 30. Is 30. And then somebody will come and require you to calculate what we call the theoretical X rights price. This is a very easy thing to do. Theoretical X rights price is a very easy thing to do. So in this case here, what will I do? I'll come and do a small table. This is 1 new. This is the right. So it is 1 new share, of course, at the new price. New price in Ngapi, somebody new price up at the rights price is 30. So 1 times 30, this gives me 30 bob. Right? And then we have 1 old. 1 old at what price here? Somebody 1 old. Not 1, but 5. For every 5 shares held. So these 5 are the old shares. So 5 old at the normal price or at the old price. Old price, which is what? Which is 50. So can somebody guide me? What is 5 times 50? What is 5 times 50? What is 5 times 50? This gives me 200 what here? 250. And you were told in that video very simply that theoretical X rights price is the average. Is the average price. So average price, ladies and gentlemen, if you add the total value here, this will be 280. This 280 is now for how many shares? 280 is for how many shares? 280 now is for how many shares? 6 shares. If you come and add these two, so in this case here, the theoretical X rights price is the average. You need to come and take here 280. You divide this by what here? Somebody divide this by 6. So 280 divided by 6, you'll be able to get the theoretical X rights price. All right. So like this question that we are doing, can somebody in this case here go back and read for us? This is a rights issue of how many shares to how many shares? Let's read this question. It's a rights issue. It's a rights issue of how many shares for how many old shares? Can somebody in this case here read for us that rights issue? That rights issue, what do we have there? The rights issue, what do we have there, somebody? What is the language? 1 new at 60. You can even see Lucy is giving us. You can even see Lucy is giving us the figure. Amesema 1 new for what here, somebody? 1 new for what here, somebody? For 60. 1 new. Is it 3 old at 84? 1 new and then 3 old. Aye, abracadabra. So 1 new at what price? The new shares transported at what price? The new shares? The new shares need 60. Thank you very much. How about the old shares? Going to trade for how much? The old shares going to trade for how much? 84. 84. So then this one here will be 1 times 60, which is 60. 3 times 84, which is what here, somebody? 3 times 84, which is 252. So in this case here, please give me the total value. Kiongeze na kuja 300 and what here? 300 what here? 12, right? 312. But now the number of shares on the other side is happy somebody, it's 4. So number of shares held in 4. Kwa hivyo sasa kumaanisha the theoretical X rights price will be this total value over the total number of shares, the average. 312 over 4. Which gives me what figure, somebody here? Which gives me 17. Which gives me 17. Which gives me 17. Which gives me 17 like that. So now, have you been able to pick this one of theoretical X rights price? Yeah, great. Makosa ulipogundua ni video na unajua umelipa for live class, switch off. Or unajua umelipa for live class and now we are having a video, switch off. Otherwise the concept in this case is very easy. It's very easy. Great. Now, as a gentleman, then how do we use this to validate the bonus? Now, this is where I will start from. Theoretical exercise price. Thank you very much. Now, nataka tuanze hapa kwa klasi ya kesho. Alafu kuna kitu moja si understand. Mbona wanafunzi watakangi klasi ya 6 p.m.? Mnakuwa wapi 6 p.m.? Class tu hata kama ni 30 minutes class ama 1 hour, well simply come and do one question. Unaendanga wapi your time? 6 p.m. Unakuwa wapi? 6 p.m. or other classes. Oh, okay. Na lunch hour je, because kama isa ningepata like one session, nifanye paka diluted, mngekuwa sawa sana. Au mnakuwa in transit. Na lunch hour je, lunch hour ni mzuri sana. Lunch hour mkoaje? Because I should not go to this with this lesson to the next, this topic to the next class. No. Lunch hour is challenging sana, tricky. Right? Accountants are so busy people, right? I know 8 p.m. is the best, but now you see, like me, I have classes throughout. Our classes throughout, and I have to give you extra sessions. Feel that. At least I can see what student hapa amesema. For the first time, I've found it easier to calculate this theoretical exercise price. Great. The average price is the average price. Is average price. Is average price. Let me see the new comments here. And I'm supposed to run home very fast. And the morning is the best for him. Safi kabisa. Then I think I have to make a decision. This class, audit about tunafanya every day early morning. We'll need to change that class because audit is easier. Your class iende kwa normal timetable. Early morning tuweke AFR, I mean. Early morning tuweke AFR. Let me discuss with those students. Tomorrow. Niwaeleze AAA, it's an easy paper. We take it to the normal time ilikuwa weekend. Early morning tufanye AFR nataka mara 3. Nataka mara 3 kwa wiki. Okay, but now please do me a favor. For EPS, I'm sending you immediately how many videos? 3 videos. The EPS, two more. Plus this, there's supposed to be 3. Plus this, there's supposed to be 3. Please for EPS, ensure kama umejua kila kitu. Nikija hapa nikusummarize na swali moja peke yake, hiyo story imeisha. Niende kwa deferred tax, employee benefits, etc. To discuss kwa group. Hata si kwa group, I'm supposed to be home now. Thank you very much. Asanteni sana. Good night. At least hamjatoka bure. Bye. Bona sawa, one thing at a time. Sikuna wasiwasi. One thing at a time. Hujatoka bure. Bona utajua. Na join aje groups. Robin uliingiaje class wewe? Robin napenda kuchunguze. Umeingiaje hapa? Robin, if you have my number, please talk to me. Talk to me after this. Hapo niambie umetumia, there must be a control weakness. Umetumia namna gani ukaingia kwenye darasa Robin? Ndio namba yangu Robin, nitafute, we talk, we shall overcome. Thank you, bye. I will sleep